What's a box of sneakers really worth? It's a question that can literally make or break a company's financials. Today, we're going to pull back the curtain on IAS 2. Think of it as the global rulebook that dictates how every company has to value its inventory, which is, without a doubt, one of the most critical numbers on its balance sheet. Okay, let's really picture this. Imagine a warehouse just packed to the rafters with the latest, coolest sneakers. How much is all of that worth? Now, the easy answer is just, what the company paid for them. But as we're about to see, the real answer is a whole lot more complex and honestly, a lot more interesting. So here's our game plan for today. We're going to start with why this is a problem in the first place, define what inventory actually is, uncover the one golden rule you absolutely need to remember, and then we'll get into the nitty-gritty of costs and why telling people what you're doing matters so much. So let's dive right in. So the first big question is, why? Why can't a company just decide for itself what its stuff is worth? Well, because without a common set of rules, financial statements would be the Wild West. Seriously, it would be completely impossible to compare one company to another, or to have any real trust in their numbers at all.
The real issue here is that value is a constantly moving target. The price of rubber for those sneakers? It could go up, it could go down. A new fashion trend could pop up and suddenly make your current stock look old. Or, hey, a forklift driver could have a bad day and wipe out an entire pallet. IAS gives everyone a consistent way to deal with all this real-world messiness.
So, before we can figure out how to value something, we've got to be crystal clear on what that something even is. So, according to the standard, what exactly counts as inventory?
The word inventory is actually a lot bigger than you might think. This definition covers 3 key stages. First, you've got the finished sneakers, in boxes, ready to ship out. That's inventory. But it also includes the half-made sneakers that are still moving down the assembly line. And it even covers the raw materials. The rolls of leather, the rubber, just sitting there waiting to be used. All of that, it's all inventory. All right, let's talk about a super important concept, net realizable value, or NRV for short. This is not just the price tag on the box. Think of it as the cash you actually expect to pocket. So you take the selling price, and then you subtract any costs you still have to pay to finish the product and to actually sell it. Things like shipping or a sales commission.
Now this is a big one. It is so important not to mix up NRV with another term you hear all the time, fair value. Think of it this way. NRV is personal. It's what your company expects to get for its sneakers based on its specific situation. Fair value is universal. It's what anyone out there in the market would be willing to pay. And believe me, those two numbers are often very different.
Okay, we've laid the groundwork. Now we are getting to the absolute heart of IAS 2. Seriously, if you remember only one single thing from this entire explainer, make it this.
Inventories must at all times be measured at the
lower of cost and net realizable value. That's it. That is the golden rule. So you figure out the cost, you figure out the NRV, and you have to put the lower of those two numbers on your books. It's a rule of prudence. It's designed to stop companies from being overly optimistic and overstating the value of their assets.
And this quote right here just sums up the whole philosophy perfectly. The entire point is to be realistic. This principle makes sure that the value of inventory you see on a balance sheet is a number that the company can actually get back, one way or another.
So the golden rule is the lower of cost and NRV. We just unpacked NRV, but what about the cost part? What actually goes into calculating that number? Well, as you're about to see, it's a whole lot more than just the initial price tag.
The true cost is kind of like a recipe with 3 main ingredients. First, the costs of purchase. That's the price of your materials, plus things like import taxes and shipping to get it to your factory. Second, the costs of conversion. This is the factory work, like the wages for the people building the sneakers and a fair share of the factory's electricity bill. And finally, any other costs you needed to get the inventory ready, like, say, a special design for a specific customer.
Now, just as important as what's in the cost is what's left out. So if a machine goes haywire and ruins a whole batch of leather, that's considered abnormal waste. You can't just bake that mistake into the cost of the good sneakers. No, that becomes an expense for the period. Same thing goes for the salaries of the office staff or the costs of your sales team. They aren't part of making the product, so they're kept separate.
All right, now for a classic accounting puzzle. Let's say your warehouse has 10,000 pairs of the exact same sneaker, but you bought the materials in 3 different batches when prices were different each time. So, When you sell a pair, which cost do you use? Well, IAS 2 gives you two main options to handle this.
You can use FIFO, which stands for first in, first out. It assumes the first sneakers you made are the first ones you sell. This means the inventory you have left is valued at the most recent prices. Or you can use the weighted average method. This blends all the different costs together to create one average cost for every single pair. This is great for smoothing out the bumps if your material costs are all over the place. And here's the kicker. Choosing between these two isn't just some boring detail. It can have a major impact on a company's reported profit.
So we have the valuation rule, we've got the costing methods. But none of this works for the rest of us if companies can just keep their choices a secret, right? That's why this final piece of the puzzle, disclosure, is arguably the most important of all.
This is really the key to the whole thing. A company can't just pick a method in a dark room and not tell anyone. It has to publicly declare its choices in its financial statements. This is all about transparency. It lets investors and analysts understand the numbers and, just as importantly, lets them compare company A with company B on a level playing field.
And the standard is very specific about what you have to share. You have to say which cost formula you used, state the total value of your inventory, show how much you sold, and this one is huge. You have to disclose the value of any write-downs. That means if you had to apply that lower of cost or NRV rule and reduce your inventory's value, you have to tell the world exactly how much that was. For an analyst, that single number can be a massive clue, a huge red flag, or even a positive sign about a company's health.
So we'll leave you with this thought. Now that you understand the rules of the game, what stories can you find hidden in a company's inventory numbers? A big write-down might be screaming that demand is falling. A sudden change in costing method could be a sign they're trying to manage their earnings. Because when you really learn how to look, you realize the story of a company's inventory is very often the story of the company itself.